10 minutes. That is the window a founder has to stand before elite investors and justify their life's work. The fear of rejection is absolute. It is a unique financial gauntlet. Founders are asking multimillionaires for immediate capital under studio lights with zero margin for error. These battles take place inside historic arenas, where every stuttered answer and bead of sweat is documented for a national audience. But when those investors finally decide to write a check, what are they actually buying? They are buying the founder. Tech tycoon Peter Jones has famously refused to invest in entrepreneurs who appear scruffy or unprepared, regardless of how much money the product might make. Deborah Meaden applies a different pressure. She looks for long-term vision, demanding a clear 5-year exit strategy before she considers the first pound of investment. The pitch is less a product demonstration and more a psychological stress test. Before the dragons evaluate the margins, they are probing the founder's leadership and resilience. Success in the den follows a specific pattern. Clarity must beat complexity. The most effective pitches eliminate industry jargon entirely. In 2007, Levi Roots bypassed corporate stiffness by bringing personality into the room, playing a guitar while presenting a simple family sauce recipe. That performance secured a £50,000 investment for 40% of the business. It became the foundation of a £30 million brand. A successful deal in the studio creates an immediate path to scaling, moving products from a kitchen table directly onto national supermarket shelves. Bidding wars are often sparked when founders prove they have solved a universal problem. Brands like Skinny Tan and Snope won by demonstrating clear consumer demand the dragons couldn't ignore. That market validation drew in Kelly Hoppen, who provided the strategic investment needed to take the Skinny Tan brand into international territories. Piers Linney has taken a similar approach, backing data-driven founders who arrive with a perfect understanding of their specific market demographics. The founders of Wonderbly secured the smallest equity giveaway in the show's history, just 4%, because they entered the room with unshakable sales figures that left the dragons with very little room to negotiate. Victorious founders do not ask investors for belief. They force the dragons' hands by presenting undeniable, tangible proof that the market has already accepted the product. But for every success, there are the silent questions that lead to the phrase every entrepreneur dreads: "I'm out." This chart shows the primary financial tripwire. Gross profit is revenue minus the cost of goods, but net profit is the actual cash left after every other expense is paid. Confusing these numbers instantly signals that a founder lacks financial competence. The creators of Magic Whiteboard nearly lost their business when Peter Jones aggressively rejected their pitch. He wrote himself out of the deal on the product itself because their high valuation ignored the actual risks of the startup. Theo Paphitis ultimately saved the deal, but only after the founders swallowed their pride and accepted the dragon's harsh critique of their business model. In this environment, a single defensive argument or a mathematical error reveals an uncoachable founder, making the business entirely uninvestable. What happens when the elite investors in the room get the numbers wrong? In 2008, the founders of BrewDog were rejected by TV producers before they even reached the den, despite seeking just £10,000 for 20% of their brewery. That initial request was a tiny sliver compared to the company's eventual £2 billion valuation. It serves as a reminder that the market's judgment is the only one that truly matters. Modern founders are finding new ways to bypass traditional gatekeepers. Hair Syrup used viral success on TikTok to prove their demand, bypassing investors and going straight to their customers. This creates a new era of creative negotiation. Giving away more equity to secure two specific dragons in a 50-50 split can be worth more than the cash itself, unlocking distribution networks and contacts that a single investor couldn't provide. Once these companies conquer their market, their real-world economic impact far outweighs the drama of their initial pitch. Great founders do not enter a room hoping for a handout. They arrive as the catalyst for an expansion already in motion, shifting the pressure onto the investors to decide if they can afford to be left behind.